1 second. All right. I should be broadcasting. I'm trying a different format here for this broadcast, so I'll want some feedback from people on it. If it's making things too small, I won't use it, but if it isn't, then I will. But first, the disclosure. I am an associate member of T3 Trading Group, which is an SEC registered broker-dealer and member of FINRA SIPC. All trades placed by me are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. Position disclosure here. I got out of the VXX short when it gapped in my favor pretty nicely this morning. And I entered a little bit of a TQQQ short today, which I may be regretting a little bit. I've only ever found, for the most part, that hedging cost me money. But we can talk about it in a second and try to figure out whether or not it was a good idea or not to keep some TQQQ with the degree of this market move. All right, so let's jump into our market here. The S&P closed up a resounding 2.14%. NASDAQ 3.1%. These numbers are insane. Look at that SPY daily chart. And the IWM here closed up 2.5%. And that's after the Russell pulled back a good bit from its highs. And then those MOCs, I don't know if they flipped or paired off or whatever, but then we saw like a rally back on the close. All right, let's talk about this market. So the first thing that stands out to me is this headline or whatever you want to call it. I think Pat mentioned that today is the biggest up day since March 2020. If that's not correct, someone tell me, but I think that's what I heard Pat say earlier today. It should be worth noting that historically the biggest market up days actually happen in bear markets, and that's because volatility increases so much. And again, you can even see it. I know this was just like the bear market we had from coronavirus, where we went down 50% and all the way back up. It was like the fastest down move followed by the fastest up move, I think, in history of that sort of degree. But even if you were just looking at like this initial bounce back, let me see if I can zoom in here. Yeah, this is when the market first started breaking down, right? But this, I don't have us going down to the bottom here. I really just wanted to see this. You can see how big like this up day was right here, March 2nd. It was a huge snapback. And look at the ranges on these days compared to the ranges of just typical days in the pre-coronavirus life that we all used to live. So anyway, the point on why I'm bringing this up is that in bear markets or markets that are breaking down, volatility increases. Historically, the biggest up days in the history of the market actually take place within the confines of bear markets and markets that are breaking down really hard. So let's go back to today. Today's a huge up day. It's sick how much the volatility has gone through the roof recently. These percentage moves have just been so crazy. The biggest difference though between like today's candle and like, you know, what I was just looking at in March 2020 is that this candle is basically right into all-time highs. I can't believe this market is so crazy. But yeah, this candle here for the SPYs, you know, up over 2%, is almost right back into all-time highs. So is this one of those really big green days that we see historically in more of a bear type market? It's kind of hard to make that argument when you're looking at the S&P. If you're looking at the Russell, it's a little bit of a different story. We know that the Russell's been in correction mode, right? It's pulled back over 10%, which is what we define as a correction. So the Russell snapping back 3% and having a big day, that just seems like a normal snapback. We're right into this range for the Russell that we've been in all year. We're right into the 21 EMA on the daily chart. When you get a snapback from oversold territory, we were definitely oversold on a couple of these days, like last week. When you get a snapback, where does that snapback usually bring you to? So the space between the 8 and 21 EMA. Sometimes it even overshoots that 21 EMA a little bit. So Russell has a good day today, but it doesn't get it out of the woods by any means. There's a lot more potential resistance here. We got some gap fill resistance up at like 228. We got some more resistance at 230, which is where we had originally broken out from and come back down. But the SPYs sure look really good. And then you got the NASDAQ. The NASDAQ here also looks pretty good. NASDAQ is coming up to $400 resistance, which I've been saying if the NASDAQ, the Qs here can get above $400, that's when they'll start looking really bullish. And again, you're saying that this is the biggest up day, I think, for the NASDAQ since March of 2020. But those big up days typically occur in more bear markets. Is this a bear market? This market's been so unique in a lot of ways to almost anything I've ever seen. And one of the biggest concerns I've had that I've stated numerous times from the beginning is the difference between the indices and like a lot of the stocks that you look at. And that's why I think the IWM here has been the best index to look at to give you an idea of what your average company is doing, not just the FANG names and Tesla. Because we know that there are a lot of companies out there, especially those growth names, that have just been, absolutely destroyed. So we'll see. This up move today is crazy. If we're going to continue higher, which definitely could happen, volatility should start coming down. I mean, we've already seen the VIX come down a lot into this up move. But if the market's really going to start being healthy again and being its typical bull market self and climbing the wall of worry, then, we should go back to seeing relatively small moves. Like, again, just look at just eyeball the size of a typical daily candle any point on really almost any of these months versus the size of the moves that we've seen here at the end of November and so far in December. So definitely a really bullish snapback. We cleared some really important key levels here for the SPYs, and we don't really have too much resistance left. There's resistance in this 470 area, and then you're at all-time highs. We're like a couple dollars away from all-time highs in the S&P, which is just so insane considering these movements and what some of these stocks have done. Let's talk about today's trading session, because today was actually a really hard trading day. So first of all, we gapped up huge and we ended up closing strong. Why? I have no idea why. Apple moving which way? Apple's ripping here after hours, right? Higher? Wow, it's sick. I still am long Apple, so I'll take it. Anyway, sorry, got distracted there looking at that Apple move that you guys were chattering about. So anyway, market's up huge today, right? We gapped up in a huge way, grinded higher, couldn't really roll over, digested all of midday, and then it looked like, I was expecting this rollover into the last 30, 45 minutes of the day as kind of the trend following algorithms or whatever, book some profit into the close. It's very typical on these really strong days. And we started to see that. And then MOCs came out. And MOCs were, I think, a solid sell. They were like $1 billion to sell. And then immediately that must have gotten paired off or whatever, and we just started ripping higher into the close. It's really interesting price action. What caused today's gap up? Again, just to repeat myself, I have no idea. There was nothing new that came out today except for, some stimulus that came from China. But I don't think that stimulus that came from China should be enough to bring the S&P up over 2% on the day. There were some headlines I was reading this morning that were trying to attribute today's gap up to the fact that the Omicron variant is not as lethal or does not carry as bad of symptoms as the Delta variant or whatever, it's not new news. We've been talking about that here in our meetings for over a week now. So there was really, as far as I was concerned, outside of the China thing, nothing new today. The market always likes to attribute a narrative to everything. This easily just could have been a very technical thing. In yesterday's afternoon meeting, we identified all of these reasons why the market has been weaker and so much more volatile, and we also discussed that many of those reasons were set to kind of be transitory and at least be over by the end of the year. So when you get this huge gap up, the first thing that I thought about in the morning meeting today that I discussed with you guys was not to just rush in and short this gap up. You want to, right? And forget about what the market actually did. You want to come in and rush and short this gap up because it was a huge gap up into resistance, and it was a common gap, and it was very large. We know common gaps tend to get filled, and especially if it's a common gap into resistance. But the reason why I was telling everybody we should be a little bit patient here and not just jump in and start short selling right away is because this move up was actually so big that I felt really confident that you've got short sellers trapped in this market here from these last handful of days. This selling and all this volatility that's come in, a lot of that has been coupled with funds doing a lot of hedging. And now all that hedging is just costing them a lot of money, let alone people who are just flat out net short saying, oh, finally the down move is coming that we've all been looking for, and interest rates are increasing and all this other bad stuff that's supposed to be happening. Actually, just so you know, historically, when interest rates begin to increase, it's actually usually good for markets, though we're doing this from a really unique situation that we haven't done in the past. But that was my initial thought process, was that we can't buy because the gap is too big. We shouldn't short because I really felt that there were shorts that could get squeezed here. And my expectation, based on just previous trading experience, is when we get these really big gaps and that leads to a short squeeze, it's usually not lasting for more than like 30 minutes or so at the most. A lot of times it's even less than that, 10, 15 minutes. But usually not more than 30 minutes at the most. So for myself, my original thought process here, and luckily I had a bunch of long positions, was, oh, this is great. Let me just book a bunch of profit into this. So I covered my VXX position. I sold a bunch of Apple. I sold a bunch of SoFi. Sold some of my other positions as well. And then I tried to be really patient, and it was only post 10 a.m. that I started to try to maybe nibble on a little of that TQQQ, kind of as a hedge, honestly, because at that point I know we're above 465, which is the second resistance. So technically when you're breaking resistance, you would think higher, but we're just so extended on every time frame that it's like, how is this market really going to be able to persist? And it did. And I think our boy was on TV that we like, the JP Morgan analyst, Kalanovich, I think his name is. I actually heard it on TV for once, so I should be able to repeat it. And I think he even was mentioning that this looks like an initial short squeeze here. And I was like, oh, that's cool. This guy's really smart. And my thought process is the same thought process as him. But this market held up so well. So by the time I didn't get a rollover at like 11 o'clock or so, I was like, all right, I'm not just getting this initial short squeeze pop that's leading to a rollover, which is what I originally expected was going to happen. That's why I wanted to book profit and try to hedge myself. So then what may happen, because this is what happens in a lot of these really strong days, is then you just get some profit taking, like kind of coming into the close. And that can become a little bit of a short-term feedback cycle where, I mean, you can even see it here, right? Some selling comes in, that causes some intraday levels to break, so that triggers more sell stops, that brings the market a little bit lower, and that's exactly what was happening in the close. I was like, all right, we're getting our rollover here in the last 45 minutes of the day. Exactly, I think I said it at 2:45. I was warning, a couple of you guys were trying to buy Macy's at like 2:45, and there was a little bit of a pop. But I really just wanted to warn you guys because I saw you doing that. I was like, you might be fighting the market here because usually in these types of situations we start rolling over into the close. And so hopefully nobody got too hurt in that Macy's, or you caught enough of a move to be able to cover your risk before it rolled over. I don't know why I went to the TQQQ, go back to the SPYs. So it's exactly what happened, but the big surprise to me was the last 10 minutes, and even now, post this market close, the fact that we're continuing to rally here in the SPYs, the Qs, Apple. I think that it's still people who are stuck short. You know, the amount of selling that we saw recently in this market environment, I think that this is people who are still stuck short, and that's why these ranges are so big. What I want to see as someone who is primarily long is that this is not just a short squeeze. I want to see real buying starting to come back in the market. And I actually think that sometimes a short squeeze can actually be the beginning of real buying starting to come in, because we start with these panic shorts getting smoked, and there's still a real chance that, you know, maybe that short squeeze is just there's a lot more juice to it than I originally thought, and it wasn't just that first 30 minutes or whatever, and you know that's why we had such a sustained bid all day today. But at a certain point here, one of two things should happen. If it's really a short squeeze and those shorts are then gone soon and no new buyers come in, then volatility will potentially stay elevated and we'll see a bigger pullback. But another situation that could happen, which I've definitely seen before as well, is you start with the short squeeze, and then at a certain point that short squeeze just turns into a real bit of buyers coming back into the market. And the same like vol control world that has to deleverage when the VIX increases, stuff that Pat loves to talk about in his morning note, that same control world then starts coming back on the bid with that continuous infinite bid that we've seen for years and years and years. So I don't know. I don't know which one of those scenarios is going to play out at this point. All I can do is talk about these technicals, and the technicals here cleared two major levels. We gapped up above that really important 460. We traded through very impressively 465, and now we're approaching this kind of almost final level here for the market of 470, and we'll see if we're able to get above that or not. It's crazy to say this, but we're actually extended to the upside in the SPYs. The S&P here is now extended to the upside by $9. It's such a crazy move. It's really like mind-blowing. Take a quick look at the NASDAQ. NASDAQ's got this big resistance of 400, so we're almost into that $400 right now. Huge gap and go on the NASDAQ today. And then the Russell also, you know, really solid gap and go, but also now into resistance. All three of these indices are at next levels of resistance. The SPYs here, 470 is basically resistance in front of all-time highs. The Qs here have a big level of $400, and the IWM here has this like 226 area, which coincides with the start of the gap and the 21 EMA, and then the next resistance area at like 128.75 or sorry, 228.75 or so. So we'll see how that plays out. I did keep some of this TQQQ short as a hedge, just because of how big and how fast this market movement was. But I'm thinking, based on how we rallied into the close here, that I might just be trapped in this hedge a little bit, and it might be a mistake that I'm keeping it, because that was a rip your face off rally in the last 10 minutes, and then we're even continuing higher right now. I don't think I'm going to get out of this right now after hours. I could. But in hindsight, I probably wouldn't have kept it. I probably would just look to see if I could short a gap up tomorrow to hedge myself at this point, instead of actually having that new position on today. I, for the most part, I think I said this twice already today during the day, have only ever found that hedging myself costs me money. I don't know. I just don't tend to do well with it. And because of that move here, I traded the TQQQ pretty well, considering how strong it was. And it was looking like I was going to close the day positive on it, but then we had this rip into the last 10 minutes where I'm actually negative on that TQQQ hedge as well, which you almost would have to be if you shorted it today at any point, because of how big that move was. I don't really have anything as far as individual names go. You know, I said it in the morning meeting today that I didn't really have too many individual names that I liked because the gap was so big. I know that we discussed a few, though. We discussed this Bumble through 36. That gave a strong initial move here, but then didn't really give any follow-through and closed a little bit weak. I know we discussed this COMM that also got upgraded. I originally liked this as a trade versus like 1040 or whatever. I think gapped up a little bit too big, even though there's another resistance level there at 11. So I don't know if any of us got involved in that. This MUR was a trade that was not one of my ideas. It was one of your guys' ideas, but I wrote it down as an idea that I really liked from the meeting. So we talked about being long this MUR versus 28. That also got upgraded. And then I did trade a lot of this Sumo off of its earnings report. I thought that the earnings report was pretty good. I was coming in and being a buyer of this thing as soon as the market opened, which I think I was communicating to the team, and that $15 is a big resistance. So the fact that this closed above $15 is making this thing starting to look good here for the first time again in a while. That was a really big move to close above that 15, so we got to see if it's actually going to stay above it. This turned out to be by far and away my best name on the day. I did really well with it. And yeah, that's really all I got. So happy to take a look at what you guys got. Scroll back up into the virtual trading floor here. Go back to about 10 after 4. What's Stitch Fix doing after hours on its report? Down solidly. Looks like they beat on revenue. Am I reading that? Loss of 2 cents a share instead of an estimated loss of 13 cents a share. So that's also a beat. But they're guiding lower. You can't guide lower. You can't be a growth company and guide lower in this market environment. They will punish you. It doesn't even matter if the initial numbers beat. And then we got ChargePoint that came out also, right? CHPT. ChargePoint is down from where it closed a little bit as well, but not too dramatic. All right. Anyway, let me look for questions in here. I can look at earnings. I can look at earnings stuff later. I think it was the right idea, Greg. You know, if you were trying selectively and patiently with risk management to short some TQQQ or whatever today into the degree of this move. You know, you don't want to be entirely results focused in your trading. You don't want to just look at the fact that you might have been down some money by trying to short the market today and think that that means you did a bad job. You only did a bad job if you weren't managing risk properly, if you didn't have a stop loss in place, you know, things like that. But especially if you have like long swings on, which I think you do, and I know I do, and this market's up as big as it was today, to try to hedge yourself a little bit with some selective short trades in the market, I think was the prudent thing to do, even if it cost you a few bucks. Apple told suppliers to quicken iPhone output. All right, well that's why Apple's up. That's why the Qs are up even more here after hours. Qs are up like $1 after hours already because of that Apple headline. That's sick. I think next from here is going to be from Robert. What would you do if you would be a novice trader and coming flat into these market conditions every day? It's very difficult to take any trades. Almost all what I am doing is just scalping. So it's a good question, Robert. I think it very much depends on the day, on how we're gapping. You know, certain of these gaps are going to be giving us, I think, a good advantage, and certain of these gaps are going to be doing the opposite. And today I think it was the opposite. Like Felipe was saying it, Pat was saying it, I was saying it. It seemed like, you know, a lot of the best traders in the team here were all saying this morning, oh, this gap up makes this opening so difficult. So I think it's less about the market conditions and it's more about where we're gapping to. You know, broadly when volatility increases, and I like volatility. You know, volatility generally increases my profitability. But I don't like insane amounts of volatility because then the risk part of the risk reward equation starts getting a little silly at certain points. And I know for myself, like, I made a lot of money yesterday and today overall. My P&L swings are too big right now. The P&L swings I'm having right now, even I'm saying this even as I'm having them the last couple of days on the upside, it's too big. But that's a function of the volatility in this market. So generally, volatility means you want to take less stock and give more space risk. And again, we want volatility broadly because it creates opportunity. But especially if you're like a newer trader or a smaller trader, if you've got huge amounts of volatility like we've seen pretty recently, that's actually not good for you because it becomes difficult to really find trades that are appropriate for your risk parameters and your account size. So I don't want this market to go back to no volatility and go back to like that relentless grind up that we've seen. But I'd be happy if it toned it down a little bit for all of our sakes. These P&L swings are making it hard to sleep. So, Robert, I think you just got to take it day by day and always be focused on risk management and, really just start by focusing on the big picture analysis of the market and big picture game plan like we do each day and kind of take your cues from that. Yeah, Greg, we like that one. Next here from Ben. Gapping above the moving averages have to do with the run? I don't think so. I don't think so, personally. I think that just broadly the degree of the gap up took the short sellers off guard and caused this market to rip higher. I don't think that just because you're above a moving average or below a moving average or whatever that necessarily keeps buying or selling. I think that had more to do with the degree of the gap. From Cap Holmes, adding to this, can we analyze something by the width of the EMAs? Yeah, so I always talk about where the market is trading in relation to the space between the 8 and 21 EMA. So I consider the space between the 8 and 21 EMA on any time frame that I'm looking at to be what I call technical equilibrium. And if we're in a strong market, the upper band of that technical equilibrium will be the 8 EMA. The lower band of that of the equilibrium zone will be the 21 EMA. If we're in a weaker market, like we were here in September, October, that's kind of trending down like it was, at least on a small time frame here, then your lower band of equilibrium becomes the 8 EMA, and the upper band of equilibrium is the 21 EMA. But it's the same thing. The space between the moving averages is the equilibrium zone. So I talk about that all the time. I don't talk as much about, and Pat sometimes does, which is why it's great to get a different feel from different traders, about the amount of space, the width between the moving averages. So the width between the moving averages is going to tend to increase if you're having larger consistent moves in one direction or the other. You can even kind of see it, just look at this grind higher that we were having in like July and August in the S&P. We weren't having a fast move up, but it was almost like a little bit every day we were working our way higher, and you can see on that kind of grindy move up that the width here between those moving averages was a little bit tighter. And then when you get the price action, and obviously when the price action is switching from more bullish to more bearish or whatever, then those moving averages tighten up and then eventually cross and then re-widen to the downside, especially as the market move gets faster. But you can see here when we had that breakout in this market, second half of October into the first half of November, that the range higher here was fast, to the point where there were a couple occasions, and it never really fully manifested itself, but one of those occasions was at highs, that I was starting to become worried about the market actually going parabolic to the upside. And I just type up the Qs here because I remember particularly seeing it in the Qs almost near the top, which is not a coincidence. It's not healthy for bull markets to go parabolic. It's actually healthier for a bull market to do more of what I was just pointing out here in the SPYs last summer, where it's just kind of grinding higher and grinding higher and grinding higher. That's actually a healthier bull market. This can be sustained for many more days than these parabolic moves. They tend to not be able to last without getting a real price correction or time correction, which is eventually obviously what we got before the market itself totally broke down. But when you've had those fast moves and you get that technical correction, again, it can mean a wider snapback, because there's going to be so much more room to even in the 21 EMA compared to where that 8 EMA is. So you might be looking at a bigger move than you would be otherwise, and just like kind of that grinder type market. So it's a good question there, Cap Holmes. Next here from Rich. In your Why Traders Lose Money video on YouTube, you speak about the limit down topic. For example, if I set my max limit to $500, does that include swing trades or only your day trades? If I'm in the money on swing trades, should I exit my positions if I have hit my max loss that was set for that day? Rich, that's a great question. It's a really great question. I think that applies. So if you follow the swing trading rules that I try to follow, then I think it's really going to primarily just apply for your day trading. So the swing trader rules that I try to follow dictate that you should really only be swinging positions that you're in the money on. So if you're in the money on this position and the next day it's moving lower or gapping lower, you're just giving profit back. So I wouldn't let that hinder like the actual trading I'm doing for that day. The trading I'm doing for that day should be, my max loss should be based on that, and not just that I'm giving back some open profit, which is really not a problem, and that's how you're going to maximize your reward. With that said, one of the most important things if you do both day trade and swing trade like I do is you need to always know and be comfortable with the total maximum amount that you could lose. So for example, if your typical daily loss limit's $500, that simple example there, and you've got a swing position that you're $500 in the money on, but it's pulling back against you, and your swing position could end up going, $500 against you, and if all of your trades work that day, it'll be another $500 against you. So you could be down $1,000 on the day, but half of it really is just giving profit back. Are you comfortable with that number? And if the answer to that is no, because of bigger account management, then you need to tighten up your daily limit for that day. If the answer is yes, then go for it. But that's how I would think about it, Rich. Great question. Gabriel asking about MUR. Yeah, MUR I didn't trade today, but one of you guys had this as an idea in the meeting, and I liked it because it had an upgrade. It's a good sector. So there's a relative strength there, and $28 was a level. So I had talked about in the meeting that you could be long versus 28. Yeah, you had to pay up a little bit. So I don't know if it was worth it. I don't know if anybody really traded this or got stock, even though it was one of our ideas today. I think if you were buying this, you had to take a lot of initial risk, probably more than I would like to take, to be honest with you. You're probably taking, 50 cents of risk, something like that, I think, to get this stock here versus $28. With the idea that you very quickly, because how strong it was, would be able to raise your stop to the low of the day, so you're taking a lot of that risk off pretty quickly. But at least initially you got to risk 50 cents on it. If you're risking 50 cents on a $28 stock, even if you like the breakaway gap on the news, I don't love that, especially when I would kind of be inclined to the thought process that you might be fighting the market today by being long this thing as well, which obviously turned out to not be true, but it could have been a layer of probability against the trade as well. I just lost where I was. Sharir asking about Datadog. Yeah, someone asked about Datadog in the morning meeting too. It may have been you. But we just had the same problem with, the biggest issue today was there was a lot of decent looking stuff out there. Honestly, I like this Datadog. I like the idea, just looking at this daily chart, of being long off of these two lows here, and it's definitely a company that there's a lot of reason for you to like as well. And I know this thing gave a huge intraday move, but this gap was just so big today. I think it really made that difficult to have the conviction to come in and buy this in the first 5 minutes of the day, and give it all the way down to 162 or whatever. It's just a difficult trade, Oh man, I'm sorry. Excuse me. It's just a difficult trade. The degree of the gap this morning really, unfortunately, took away, in my opinion, a lot of the intraday opportunity from today's trading session. Next here from PT. What do you think of this big drop in Stitch Fix? Yeah, so I just briefly looked at the numbers and kind of read them out loud. But it's like I said, these companies, these growth companies, You cannot miss. You cannot miss on your guidance. If you're a growth company and you're not showing growth in a rising interest rate environment, you're going to get punished for it. And look, this is another one. Look how insane this move is. I think it's on my list of beaten down stocks. The high of the year here is $114, and it's currently trading at 20 right now when we're having this conversation. It's terrible. It's terrible. But I'm not touching stuff like this right now that's missing on its it could catch a bid just by how much it's beaten up at this point, even coming into it. But I'm not coming in and buying stocks that are missing on their forecasts, because we're seeing those. I mean, that's what happened with DocuSign, right? Look at this DocuSign. How much was it down on this day? Like 40% or something? It was insane. And it's because they missed on the guidance. Can't miss on guidance right now. Next here, I'm seeing from Ben. Same as Robert. I'm a novice trader, coming in flat after charting weekly, daily zones this morning. I thought that we were gapping into supply. I totally agree with the thought process. So I had a short bias coming in this morning. So did I. And you waited for a short entry and you got stopped out in the morning at 11:14. So that's a good job. So it's a good job if you were patient on the entry because of what we discussed in the morning meeting. And then you eventually went forward after waiting a while, and the market continued to be strong, and you got stopped out because you managed risk on your trades. Everything I'm hearing right now is a good job. Everything I'm hearing so far is a good job. Let me read the rest of your question. What do you do psychologically at that point? Because I was trying to be patient for a short entry, which I still mistimed. I missed what would have been a great long. Now I think you're overthinking it. No, I love the first half of what you're saying. I love your thought process. I think that the entire thought process is correct. We're in the trading business, and what you're supposed to do is exactly what you're describing. Come up with ideas that have good risk reward and a decent probability of success as per the layers of probability that we like to look at. So that's exactly what you did here. And there's no such thing as 100% probability of success, and the trade failed. So what do you do when you have a trade idea that fails? You stop yourself out and you manage your risk, because that's how you keep yourself in the game to be long enough to become really profitable at it as a newer trader, and you're going through the learning process. Heck, even if you were a super experienced trader, you still got to manage risk. You're still going to be wrong. I was wrong today, right? Which is fine. I thought that we were gonna same thought process as you. I thought that we were in an area gapping up into resistance where gap up is massive. It's a common gap. There are multiple reasons why this market should have rolled over, but I also recognize the potential of a short squeeze today. I just didn't think that short squeeze would last the entirety of the day, which just shows you, the volatility in this market and that people were definitely trapped today. Most of the time, that's going to be a half-hour move, and instead it literally lasted the entire trading session. So you did all the right things, and don't get in your head and think that you're wrong. One of the hardest things about being a novice trader is the way that the human brain is hardwired, right? You want to think, oh, made money, I did good. Lost money, I did bad. Because it's like, I don't know, if I transported you to the future or something like that, and you're from several hundred years ago, and I brought you into my kitchen and you've never seen an electric stovetop before, and you're like, oh wow, this is interesting, and you go and touch it and you get burned, you learn, oh, that's a thing that gets very hot, I shouldn't touch it, right? And that's a survival mechanism. But when you're talking about the market, that same survival mechanism will actually do you a disservice. Because if you did all the right things today, you were patient, you had a good technical reason to enter your trade, you had layers of probability on your side, and that trade failed, you gotta recognize that you actually did a good job, and in the long run, you're gonna make money. So, don't let it get into your head. The weekly and DocuSign. Yeah. It's sick. From Robert here. In a name like Sumo, today, can we go long right at the open because it is opening flat? You got to be very careful with that and with the news. Or also, would you consider the market gap and being patient also in flat names? So Sumo had an earnings report, and it's not a super liquid name, so it doesn't really trade pre and post market. So you didn't get any clarity from the Sumo until the market actually opened. You know, I've been involved in this name for a while. I held some stock in the earnings report. So as a result, this name was heavily on my radar as a major focus for me. And I thought that the earnings report looked good, but that doesn't mean anything. Sometimes we see earnings reports that look good and the stock goes down all day. So I don't think you could just think, oh, it had news and it's opening flat, let me close my eyes and buy. For me, I was watching this and I was able to see, because this was the first and main thing I was looking at the second the market opened, was the buying just came into the tape in such a major way. And I wanted to get involved on that ride. It was like the opening price action here was doing exactly what I wanted it to do. I was watching it really closely. I had a bias in my brain already because I thought that the earnings report was good. And then honestly, the move exceeded my expectations. I didn't think that this thing was going to be able to really break 15 today. And, you know, it struggled around 15 all day, but it actually did get above and close above. So that's that. DWAC, yeah, DWAC scares me. I don't even understand if this is an actual company or not. But it is trying to base out a little bit here. If this thing starts getting above $50, it looks better. And $56 is also a little bit of a spot. I don't know. I don't know what this thing is worth. I don't know if this thing belongs at $100 or if it belongs at $2. And honestly, 6 months from now, seeing it at $100 would surprise me as much as seeing it at $5. So just trade the technicals on that one. Dare may go parabolic. Yeah, so news name here, right? So news is different. If this is sustained day after day after day after day, and that slope is continuing to increase, that's really more of what I'm talking about when it comes to a parabolic move for markets. All right, well, it is almost 5 o'clock, so I'm going to wrap things up. So it looks like I got through the questions today. Heck of a day, man. Heck of a market. So everybody get a good night's sleep, and looks like we're going to gap up tomorrow because of Apple, but we'll see. You never know what these futures are going to look like when you wake up in the morning anymore recently, right? Have a great night, everybody. I'll see you tomorrow.